Woolworths posted $18.1 billion in third-quarter sales on Thursday, solid numbers, higher than the same period last year, and the stock fell 7.5%. That single move wiped more than $2 billion from the company's market cap in one session, making Woolworths the biggest drag on an ASX 200 that was already recording its 8th consecutive day of losses, the longest losing streak in 8 years. The context matters. Brent crude pushed above US $124 a barrel on Thursday as the Strait of Hormuz remained closed, and President Trump weighed military options in the Iran standoff. Energy stocks climbed, financials and industrials were green, but materials sank 2.65%, and consumer staples, led by Woolworths, turned into the session's other pressure point. The headlines told the story in pieces. ASX 200 today, losing streak extends to 8 as materials weakness weighs on index. Woolworths shares drop despite strong sales. What happened? Evening wrap. ASX 200 makes it 8 in a row down as crude sparge hobbles mining stocks. 3 separate storylines, but Thursday's session made clear they were connected. The question the market was actually answering had nothing to do with last quarter sales figures.
The number that moved the stock was not in the revenue line. Woolworths CEO Amanda Bardwell said the company had not yet seen the full wave of supplier price increase requests. Not yet. That word carried weight, because the energy shock is not finished. Brent at US $124 a barrel translates directly into diesel, freight, refrigeration, packaging. Every link in a supermarket supply chain runs on fuel. And Bardwell told analysts the company was already investing more in customer value just to hold volume. That is the mechanism. Revenue up, margins squeezed from below by fuel costs, squeezed from above by deliberate price investment to keep shoppers from trading down. The result is a widening gap between top-line growth and bottom-line delivery. Investors were not selling last quarter, they were pricing in the next 2. The AFR put it plainly, Woolies won't waste this crisis, even if investors take a little pain. Management framed the energy shock as an opportunity to accelerate operational improvements and hold customer loyalty. The market heard something different, that the pain timeline is open-ended. Here is where it gets complicated. Woolworths shares were still 17.8% higher year-to-date going into Thursday. The stock had already priced in a strong first half. Thursday's move was not panic, it was a recalibration. The forward guidance implied that the margin compression investors feared was not hypothetical, it was already being absorbed in real time. There is a condition attached to that logic, though. If oil retreats, if the Strait of Hormuz reopens and Brent pulls back below US $100, the fuel cost pressure eases, supplier requests slow, and Woolworths Q4 looks considerably cleaner. The sell-off assumes disruption continues. That assumption is doing a lot of work.
Australia's CPI came in at 4.6% for the 12 months to March, driven almost entirely by fuel. Automotive fuel prices alone surged 32.8% in March. Economists at MLC, HSBC, and The Guardian's Greg Jericho all drew the same conclusion from different directions. The Reserve Bank is near certain to raise rates again next Tuesday, which would put the cash rate at 4.35%, back to the highs of 2024. The tension in that outcome is not subtle. A rate hike designed to fight inflation caused by oil will not slow oil prices. It will slow mortgage holders, retail discretionary spending, and business investment. Woolworths, as Australia's largest supermarket, sits in the middle of that transmission mechanism. Higher rates mean less disposable income. Less discretionary spending flows into more private label and value lines. Margin pressure compounds. This is the same pattern that played out across global supermarkets in 2022. During the post-COVID supply shock, Tesco, Carrefour, and Kroger all reported strong nominal revenue growth, while watching operating margins compress quarter by quarter. The stocks fell not because the business was failing, but because investors could see the timing gap between cost inflation and the ability to pass it through cleanly. Woolworths is not Tesco. Australia's duopoly structure, Woolworths and Coles, gives it more pricing power than most. The ACC pricing investigation that has been running in federal court is also a constraint. Woolworths' own promotional guidelines were breached, a commercial manager testified this week, as the company rushed to compete with Coles. That legal backdrop makes aggressive price recovery harder to execute cleanly. The base case, based on what Bardwell said and what the RBA data confirmed, is that margin pressure persists through at least Q1 FY27. The forward-looking case that breaks that scenario requires oil below US 100 by late May, and the RBA pausing its hiking cycle, two conditions that are not independently likely right now. What Thursday actually established is that the market has shifted from rewarding Woolworths' revenue resilience to demanding margin evidence. That is a different test, and the first clear reading of whether Woolworths passes it will come with the full-year results. Until then, the stock is a live referendum on how long the energy shock runs. The verification line is Tuesday's RBA decision. A 25 basis point hike with a hawkish statement confirms the compression scenario. A pause, which almost no economist is forecasting, would be the signal that the calculus has changed. Watch which way the board moves, and then watch what Woolworths does with its pricing in the following fortnight.